back to the Junius Maltby channel. Kind of been a chaotic morning with stocks and metals all over the place. We've seen the U.S. stocks slump, Goldman and J&J earnings reports disappointing investors. Currently, the Dow Jones is sitting down about 90 points, down 90 points. About 120 points, I believe, is what the numbers were when I first looked at it. And then, of course, gold took a steep decline overnight and then rocketed back upwards again, touching 1290. So it's sitting around 1290, 1289. And you'll see different numbers here on the screen, snapshots from different times, with the dollar down, dipping below 100 again. So gold's up amid geopolitics and a weaker greenback. We also saw silver take a precipitous retreat from its high. You can see it just fell off a cliff there, but then it's starting to ratchet back up. Started climbing. Currently, as of right now, silver's sitting at about 1823. We'll start off with Nikhil Gupta's analysis for silver, saying silver has finally done it. Silver records a breakout on the weekly price chart, momentum likely to remain strong in the near term. The probability of reaching $21 has increased. He writes, after battling repeated rounds of selling pressure and profit booking, precious metal silver seems to have overcome the final hurdle before it targets $21. This achievement has come alongside a powerful up move in gold, which is probably staring at the beginning of a multi-year bull market. This might be a good time for the shorts to cover their positions, as a massive appreciation in silver is on the cards. He goes on to show several charts that document and somewhat validate his position or his theory, why he believes silver will perform the way he believes it will in the future, showing charts that indicate the possibility for a rise in silver prices reaching that $21 per ounce mark. He goes on to write, helping silver and therefore SLV is the selling pressure in the US dollar. Very recently, President Trump voiced his concern that the greenback may have become too strong for its own good. According to RT.com, the president said, quote, I think our dollar is getting too strong, and partially that's my fault because people have confidence in me. But that's hurting. That will hurt ultimately. Look, there's some very good things about a strong dollar, but usually speaking, the best thing about it is that it sounds good. It's very, very hard to compete when you have a strong dollar, and other countries are devaluing their currency. Unquote. And taking a look at a U.S. currency, U.S. dollar chart here, you can see it is on a downward decline there. This article is sure to ruffle some feathers out there in the precious metals community. I myself was actually shocked when I read the headline and went through the article. It's going to be interesting to follow this and see where it actually goes. Turkish central bank introduces new bond to confiscate private gold assets. Now, we've covered some of the Turkish news in recent months. However, this goes into a little bit more detail about what Erdogan's plans are in seizing private gold to store up the Turkish economy. So far, this article and this story has only shown up in Azerbaijan Business Center News and as well as News BTC, which is a Bitcoin news site. So it's not really dominating Western headlines or getting a lot of press in more of the mainstream financial outlets. Moreover, the Turkish government claims to provide a fixed interest rate during the term of the gold bond. There's a picture of some gold for you, but let's get into the meat and potatoes of this article. Most people are well aware of the current living conditions in Turkey. Erdogan is making some very controversial statements which do not go over well. It now appears the country is suffering from dwindling credit and a Turkish lira devaluation. The new plan by the government is to start confiscating gold assets, a radical step that will set a very dangerous precedent, to say the least. It is never a good idea to start confiscating private assets without batting an eye. For some reason, the Turkish central bank feels that it is their best course of action right now. While the institution aims to aid citizens with financial struggles, taking away gold assets is not the answer. In fact, this is a very dangerous precedent that can effectively cripple the country in a few years. All your gold assets belong to Turkey. As one would expect, the bank is not doing this out of kindness. Instead, they aim to use these private gold assets for themselves to boost the Turkish economy, a very strange sentiment that will cause a lot of backlash and public outcry over the coming months. It has to be said, however, the bank is quite clever when it comes to confiscating private assets. In fact, they will launch 2 new investment opportunities to mask their real intentions. One of these options comes in the form of a new gold bond. The other option is a trading instrument for the loan of both gold and gold-based jewelry. While that sounds inconspicuous, the ultimate goal is far less innocent than people may think. On the surface, citizens who invest in these new opportunities will earn additional incomes. However, they are effectively turning over their private assets to the Turkish government without there being any guarantee of ever getting it back. Moreover, the Turkish government claims to provide a fixed interest rate during the term of the gold bond. That is highly improbable during these times of financial volatility. In fact, Turkey is suffering from a devaluing lira due to Erdogan's recent comments. Moreover, the country has less credit than ever before, forcing the central bank to look for other measures. In this case, going after consumers' private assets seems to be their only option. It is evident banks around the world are grasping at straws to remain afloat these days. Confiscating private gold assets in the form of a soon-to-be defaulted bond is very dubious. Moreover, it remains unclear how the bank plans to pay these fixed dividends over an extended period of time. Since Turkey can't borrow internationally, there will be no fresh capital coming in anytime soon. A very uneasy situation, that much is certain. What would a news cycle be like that includes gold confiscation without some silver market manipulation to go along with it? It's kind of like the butter on the toast. Econ 101, Silver Market Manipulation by Craig Hemke, Monday, April 17th. This is an exhausting and lengthy article, so I'm going to just take a few portions of it here for our own news cycle and enjoyment. So let's get to it. In creating and selling to specs those 23,713 contracts last week, the banks essentially minted new obligations to deliver 118,565,000 ounces of silver to the spec buyers of these contracts. That's about 14% of the silver that the entire world will produce in 2017. Was any silver placed on deposit with the exchanges as collateral for these new obligations, or did the banks simply create them from whole cloth through cash and leverage? Below are the CME Silver Stocks reports from Monday and Friday of last week. Note that the amount of silver held in the vaults actually declined over the week from 191.5 million ounces to 190.2 million ounces. And here is the chart he is referring to, reflecting the decline in silver held in CME vaults. It's at about this point in the conversation where the cartel shills and apologists jump in and claim that all of this new open interest is only being provided by benevolent and altruistic bullion banks, which simply provide necessary hedging services for their mining company customers. The banks make no directional bets. And then there's a link to the Benzinga.com, JP Morgan Commodities Chief Blythe Masters denies firm manipulating precious metals article. But there are a few common sense holes in this defense theory. The total size of the silver producer hedge book is historically low, as you'd expect with prices barely above the all-in break-even cost of production for most miners. And we're supposed to believe that, en masse, the global silver producers combined to hedge 14% of global mine supply in just the past 5 days? And what about gold? With the April 17 contract coming off the board last week, total open interest in COMEX digital gold fell by nearly 10%, or 45,471 contracts, and is back near 2017 lows. Are we supposed to believe that only silver miners are now actively hedging and selling forward their future production? So finally, the conclusions that you should draw from all of this. One, obviously the banks are still active in managing price through the issuance of paper metal contracts. They sell these obligations to speculators in enough supply as to dampen the upward price pressure that would have resulted from supply being held constant. Two, contrary to popular belief, it is most definitely not the supply and demand of physical metals which determines price. Instead, the trading and daily supply-demand of the paper derivative contract is what determines the physical price. The physical market is then contorted by the bullion banks, which manage the wholesale flow of physical metal in order to legitimize this digitally derived price. 3. It's not impossible for the paper price to rise. It's just that certain conditions must be met. Either of two things must happen. A, speculator demand for the paper derivative must exceed the bank's willingness or ability to supply new derivatives contracts, or B, banks must be forced to maintain a limited supply of paper contracts in the market. Perhaps the ability of the banks to create new contracts must be tethered to a proven and readily available amount of silver on deposit at the exchange. He closes the article expressing a sentiment that I myself have often voiced. No fraud can last indefinitely, and no institution built upon a foundation of lies and deceit can stand the test of time. Instead, the day is coming where true physical price discovery will again prevail in precious metals. What will that price be? I have no idea, but I'm quite certain that it won't be $12.50 gold and $18.25 silver. Well, as always, my friends, thanks for stopping by. Thanks for viewing and watching this boring channel and these boring videos in their entirety and getting to this point where we can say goodbye. As always, I appreciate your likes, subscriptions, and sharing of these videos, and participating in the comments and conversations down below. Don't forget to stop by the blog, where I will start putting up some different material, and that's at juniusmaltby.blogspot.com. Thanks for being here, and have a good day.